Probably if you've seen this video, I've already published another video of the trade live. So I was recording the live price action before entering the trade and after closing it. And yeah, so let's just really quick go into it. The first thing that I look at is I delineate the 8:30 a.m. open, which is, as you may see below here, we have the 8:30 a.m. candle. Anything below the 8:30 a.m. open, if we were bullish, is a deep discount, in which if you were willing to buy, it's below this price that you should be buying. And the other thing is, I look at the 9:30 a.m. open, which is this candle right there. It opened here, so I'll be just using a rectangle. Yeah, so okay, to 10 a.m. So this is the 1 hour opening range. I divide that into half, as you might see. It's already divided here. So just hide the execution symbols. They distract me a bit. So yeah, all of this right there, I look at that as a kind of Judas swing. So for me, all of this price action in the first 15 minutes, most of the time, if we were above the 8:30 a.m. and we went down lower, all of this is seen as a Judas swing, a kind of manipulation into what? Sell side liquidity. And then we have this price action here, this PD array rather. What is this? Let's go to the 15 minutes. Hell yeah. So yeah, this is the PD array, which is a fair value gap. The price traded into it here, there, and then I was trying to see if it would offer a kind of just a small retracement. I don't really care if the bias was bearish. I just want to take advantage of any small retracement back higher. And this is what I did. Yeah, so let's go back to the 1 minute and talk a bit more about the market structure in the 1 hour opening range. So yeah, here we have a signature that I try to see in price, which is looks like a kind of a high resistance liquidity, in which any movement lower is immediately rebalanced. As if you look at this, there is no fair value gap. There is no clean price action on the NASDAQ, and it's the opposite on S&P. We have clear price action going down, leaving volume imbalances, fair value gaps. It's a kind of smooth price action. So the other thing, if we took the Fibonacci and from here to here, so it took a lot of time to get to this level, and it took one candle to go above 50%. Look at this, a lot of time, a lot of candles, but to go above 50%, it took only one single candle to go above that. And this for me is a signature that I love seeing when we want to go lower, aggressive candles like this. I love seeing aggressive candles like this. I'll be putting a video of the Lash macro analysis that I was doing. I was doing a kind of tape reading, and you will be seeing my notes on the right side of the chart. I was saying 2 times, I guess, that I would like to see a aggressive return back to a PD array. So yeah, I will be trying to put in the video today or maybe tomorrow. So yeah, this is the business right there. and the second half of the opening range hour, we've had this price action going higher, which is clean. After taking out the sell side liquidity, going back to the 15 minutes fair value gap, the price went higher. This for me is a good signature. So this is for me is a model that I will be trying to use, and I actually use most of the times. We have fair value gap broken. So for me, I look at this range as a kind of balanced price range. When we have a fair value gap, I don't want to see it being traded to and then price comes back a bit lower and then go higher. So this for me, it's not the same thing in comparison to this. When we have fair value gap, I like to see sometimes, one single candle to take it out. And yeah, so I look at this as a balanced price range. We have fair value gap that was recently formed. Sometimes it just, quickly starts going higher. So the first trade that I took, I bought here, I didn't wait for it to go back to the fair value gap, because it said sometimes it runs quickly higher. And so what I did is that I've calculated from there, from here. Let's just show the trade so it'll be more visualized. I took the trade there with 2 lots, which is equivalent to 1 micro contract on the NASDAQ, and so which was I guess $50 risk. But then it went back to the fair value gap. I took another trade, and after the second trade, it's 2 micro contracts, and the stop loss then was $100 and change. So yeah, this was the explanation behind why I took that trade. The second thing why I took the trade there, I already had the idea that if it went above this high, I will take 2 lots off. So I will be getting 2 lots. The other thing that I was trying to see if it will show some kind of magnitude, some kind of speed into taking out this high. But then I was looking at the S&P, and I realized that by looking at it, it came back to the volume imbalance. So the thing that I do sometimes is I take 2 really highly correlated assets. For example, take for example the euro, dollar, and the dollar index. They are negatively correlated. Take for example the New Zealand dollar and the Aussie. They are positively correlated. In some time frames, it's maybe more than 80% correlation. And so what I do is I take the trade, for example, on the NASDAQ by S&P going back to a PD array. So let's just say that this again. I trade the NASDAQ even though it's not on a PD array, but the S&P is on a PD array. So until the next video, wish you good luck and good trading.